So my name is Ralph Koijen. I'm a professor of finance at Chicago Booth. At the conference, I'm going to talk about a research agenda that we have together with Modo Yogo at Princeton and various co-authors, and which is motivated by the fact that many questions involving financial markets nowadays are quantity questions. So examples are the impact of asset purchase programs, the growth of ESG investing, or the impact of global capital flows on financial markets. To answer these questions, we need a framework that accurately describes asset prices and quantities, that is, portfolio holdings. We refer to this framework as demand system asset pricing. We've initially applied this framework to equity markets in the US and more recently to government bond markets in the euro area to understand the way in which asset purchase programs impact yields. Here, what we do is we analyze and model the demand of different investor sectors, such as banks, mutual funds, long-term investors, and foreign investors, those outside of the euro area. This analysis reveals that foreign investors sell about 40 cents of every euro purchased by the euro system. It shows that the average impact of the program until 2017 Q4 was around 65 basis points with some variation across countries. Now, given the important role that foreign investors play, one question is how purchase programs affect global financial markets. And in particular, when central banks in various countries implement programs simultaneously, as happens right now. We therefore develop a model of global equity, bond, and currency markets by modeling the demand of global investors across countries and across asset classes. Investors' demand depend on prices and characteristics that describe the risk-return trade-off. Conventional and unconventional monetary policy, fiscal policy, and foreign currency reserve policies affect short rates and debt quantities available to be held by global investors. Our estimates highlight an important role for policy variables in explaining long-term bond yields and exchange rates, with about 40% of the variation explained in both cases. Now, going forward, we're exploring whether the model can be used for real-time policy analysis by predicting the impact of unconventional monetary policies. The demand system approach can improve upon a country-by-country application of event study estimates, which is perhaps the next best alternative, by accounting for asset demand shocks that such policies induce in many countries at the same time.